and welcome to another episode of All About Your Company. I'm 𝘾𝙤𝙪𝙩. Today we're going to be talking about Century Plyboards. Now, what I want to know, whether the plyboard business and whether this entire segment is on the cusp of a turnaround. It seems like, because Q2 numbers were materially better than Q1. Q3, the guidance seems to be that it's going to be steady state versus Q2, but the long-term guidance seems very, very robust. Let me take you through some of those numbers which they are projecting. In terms of just the compounded annual growth rate in terms of top line, Century Ply is expecting, which is currently doing sub 5,000 crore in annualized revenue, is expecting to do 12,000 crore of top line by FY31. So yes, we're 5 years out, but that will mean very, very robust growth. It will probably mean an 18% compounded annual growth starting FY25 onwards. And therefore, you're starting to see some signs of a pickup. So we'll try and get a sense from management as to what is it that they're seeing, which is playing out in the environment. In terms of what I want to know, are they comfortable with the kind of guidance they've given of 18% growth in terms of top line over the next 5 years? And how is pricing evolving currently? Because pricing has been the key concern. While raw material prices have gone up, they've not been able to pass this through to customers. And we'd like to take a pulse of what's happening on the pricing front. Also, therefore, what's happening on the raw material front. How is raw material pricing shaping up and what to expect on that going forward? In terms of utilizations, especially in MDF, where they've doubled capacity, utilizations have inched downwards. Is there a steady ramp up seen there? In terms of the outlook with regard to laminates, because they are looking at, in terms of laminates, they're looking at export markets. They've got an ex-Asian Paints head come in and take over the laminates business as well. So how is that expected to shape up, and how is production expected to ramp up on the laminates business? And with regard to cash flow, you've seen a net cash flow negative in FY25. We've seen that turn positive sharply in FY26, but is that sustainable? And how much of that unwind can we expect to continue in H2 of FY26? In terms of capex, 2,000 to 2,500 crore of capex likely by FY28, FY29, but the glide path of that and the funding and the timing. So to try and understand all of those metrics, we'll speak with Mr. Keshav Bhajanka, who's the Executive Director at Century Plyboards, joining us in just a bit. Let's talk about the company though. It's a leading Indian plywood manufacturer. It has 15 plants, 26 branches pan-India, and it is in the branded wood panels space. That's the larger focus area. Now let's talk about the products. In terms of the first product that they do is plywood and block boards. This is used in your home furnishing, interiors, and it caters to premium and mass market. They have 3 brands within which they house this: Sainik, Club and Architect. So that's how this particular vertical of the business does. I'll take you also through the revenue mix of some of these, of each of these verticals, but for the moment let's understand the verticals. The second piece is laminates. Now this is more decorative by its very nature. So panels, furniture and the like is what this is used for. It's also used by OEMs, architects, retail, and a large part of it is export as well. There's going to be a drive towards export, especially if flat laminates are concerned. So you have that focus area as well. Then the third piece is medium density fiber board. Now this is MDF, the full form of MDF. It's engineered wood, key in modular furniture, paneling, and it started to see a very strong surge, just given the fact that ready-made furniture has come into vogue in a very sharp fashion over the last few years. You've seen very strong growth where MDF is concerned. So we'll try and understand MDF a little bit better from the management. We'll also understand how margins in MDF are trending. That's the other piece. The fifth piece is with regard to particle board, right? Now, where particle board is concerned, it's a low-cost panel for carcassing, office and modular furniture. It's around 3% of the sales, so it's a very small component of the top line. The last piece is decorative veneers, doors, PVC panels, chemicals and the like. So those are just smaller segments within which Century Plyboards also operates. Let's talk about the product mix. As I said, 56% of the mix is plywood, 23% is MDF now, around 14% is laminates, and with the opportunity size increasing, and then there's particle board and others, which is just about 7% odd. So that's broadly the split. So what you're starting to notice is a large chunk of the business, nearly 90% is plywood and MDF, and then almost 80% is plywood and MDF, and if I add laminates, it's around 90 to 94% of the business comes from only these three segments, and therefore that should largely be the tilt which even you as an investor should focus on when you're looking at the business. Let's talk about manufacturing locations. They have 14 Indian and 3 overseas. They also have major sites largely in West Bengal, Punjab, Assam, Gujarat, Tamil Nadu, Andhra Pradesh, Haryana, as well as Uttarakhand. So that's broadly the geography distribution. In terms of, again, geographic distribution, 96% of the sales comes from India, just 4% exposure to exports for the moment. It sells to dealers, distributors, retailers. That's where 95% of its sales comes from. And of course, the entire model is based on manufacturing in-house and selling B2B, which is to other businesses, which is to distributors, retailers, and the like. So it's all branded B2B. There's no trading involved per se. So they manufacture it themselves. They don't trade. That is, they don't use third-party manufacturers to source and sell. It's all manufactured in-house. Now let's talk about the metrics themselves. Let's start with the P&L account. You'll see the top line growth is fairly linear. 14% top line. EBITDA is where the squeeze has happened. -3% CAGR on the EBITDA count. It's been largely flat. In fact, there's been a degrowth. That pressure has come because of raw material prices rising and not being passed through. That's the real risk where this business is concerned. And that is reflecting in the EBITDA numbers for the last 3 years in terms of CAGR. Profit also down, therefore, logically so. We're cautious here because of the scale down with regard to profitability in the business. But what's important is they've gained market share. They continue to grow. And that becomes important in a business like this, where the organized is taking over some of the market share of the unorganized. And we'll get a perspective of that from the management as well, as to how that journey is playing out and how Century is standing out, if at all, in that journey. But that's one piece. The second piece is how H1 has shaped up. And that's where you're starting to see better growth in terms of the numbers. 17% top line growth, 36% EBITDA growth, and 68% profit after tax growth. So the low base of FY25 is proving to be favorable for FY26. You're seeing that in the numbers. Let's look at the margin trajectory, and you'll see an inch up with regard to margins, but a sharp inch down prior to that. So we've seen very, very sharp inch down, and thereafter we've started to see an inch up in H1 FY26. But if you also look at Q1 versus Q2, it was sub 11% in Q1. In Q2, the margins have gone north of 12.5%. So the inch up is sharp. Expected Q3 is expected to be flatter in that sense. Let's talk about the balance sheet now. And in terms of the book value itself, it's at around 2,500 crore. And you look at the build-up in the borrowing with the amount of capex they've been doing. They've been using the borrowing to do capex because free cash flow has been tough to come through, and it's been difficult to kind of manage the business, and therefore they've used a lot of debt which has come in to try and lever the business up. That's what's happened. So we're cautious here, of course, with regard to the amount of leverage that's happened in the business. Cash at around 65 odd crore. Nothing significant to talk about. But let's talk about cash flow. And cash flow has been a steady problem. Last couple of years, we've not seen cash flow or EBITDA conversion into cash flow. And that's what you're seeing here, especially in FY25. FY26, we'll see a bit of an unwind on that count. In fact, in the first half itself, we had around 270 odd crore of free cash flow coming through. So very sharp surge in cash flow expected in FY26. Let's talk about the return ratios now. Now, this is a very high ROCE business, mind you, viewers. So with all of the problems it's facing, it's still done 18% in FY24, It's dipped to 10% in FY25 with all the capex they've done as well. I wonder when does it rebound and when does the cycle shift. But at its peak, it was doing a 30% ROC at one point in FY22. So that's something you want to keep on your radar. In terms of how the shareholding has panned out, very, very steady. 73% shareholding with the promoters. No concerns whatsoever. FIs have a little bit of interest. DIs do have nearly a 20% interest. And then there's public. But just the promoter interest there for a 17,000 crore market cap company to have around a 73% promoter ownership looks fairly healthy. So therefore, a thumbs up here. In terms of valuations, you look at the 1 year forward PE for the last 5 years. The range has been 23 to 51. So it's been a very, very wide range. It currently trades at 39 times 1 year forward, but the base is lower, viewers. That's something you want to mark out. If you saw the numbers, there's been a very sharp jump in H1 FY26 versus H1 FY25. And therefore, the 1 year forward will likely continue to unwind in terms of the margins starting to inch upwards, hopefully. That's what is getting built in. But the 5-year average is also 35 times. So that's something you want to contextualize and take care of. But that's broadly the way in which valuations work. We're a bit cautious here because it's still 1 year forward is still slightly above the 5-year average. And even when you're looking at the range, the 5-year range, it's slightly elevated even within that 5-year range. But this could well unwind very quickly, and we'll try and understand some of that from management, and then you can make a better judgment of this. But we're cautious on this count. Now, last piece. Let's look at what analysts are recommending. 13 buy calls, 8 hold calls, 2 sell calls with a 13% upside is what analysts are seeing. So that's a thumbs up, a decent upside at least that's what analysts seem to be suggesting in their, as part of their opinion. But broadly, that's how it shapes up in terms of a single snapshot on how this looks. Let's go across. We have Mr. Keshav Bhajanka, who's joining us, Executive Director at Century Plyboards this afternoon. Keshav, hi. Very good talking to you, and it's always good speaking with you. Let me first start off by understanding how pricing is evolving in the current environment. Are you seeing an inch up? Are you able to pass through a few price hikes at least, or how is the environment shaping up?
Good afternoon. Thank you so much for having me on the show. I think that you're right that in terms of pricing, there has been a slight movement upwards, particularly in the categories of plywood and laminates. In these two segments, we have been able to take price increases, whereas for MDF and particle board, I think prices are stable. However, the trend of reducing prices is or should be behind us. Alongside that, the raw material inflation that had taken place over the course of the last 2 years, I think the peak is behind us. So going forward, I don't see any need for steep price increases, but as and when there's a requirement, we will definitely be taking the same.
Understood. You spoke about how raw material prices are getting a little more stable now. Keshav, it creates a lot of choppiness in your business, right? Is there any way to hedge around it?
I think with regards to both plywood and laminates, there isn't so much choppiness because in plywood and laminates, we have the ability to take price increases as and when there's an increase in cost. Perhaps in the case of MDF and particle board, due to the current oversupply position, it is more difficult to pass on cost increases in the form of price increases or raw material escalations to the market. But I think that, again, is a short-term phenomenon. Going forward, we are now inching up towards higher capacity utilization as an industry. And most of the capacity that had come in, bulk of capacity additions are behind us. So I think going forward, over the course of next year, you will see price increases across MDF and particle board as well.
Oh, very interesting. And that will obviously benefit you. So you're saying over the next 12 months, is there a better timing, or will it just gradually start to phase upwards in terms of pricing as well as in terms of margins?
I think from H1 next year, you should see increases in both pricing. As far as margins are concerned, we have given margin guidance for the current year, where in plywood, we have given 12 to 14%, in laminates of 10%, or in MDF of 15%, and particle board steady state of 15%, but from Q4 onwards, single-digit EBITDA margins as we ramp up our new capacity. So I think we're fairly certain of delivering the same, and hopefully we'll be able to outperform.
Understood. And Keshav, you've done very well to acquire market share during a very difficult period of time. Market share is coming from unorganized. Are you also taking market share from some of the organized players? And are they facing difficulty and problems? Because you're a large player within this space, and therefore you have that advantage to be able to not hike prices and still survive. So I'm trying to get a sense as to how's that playing out.
I think if you look at segment by segment, there are of course large players. There would be other large players in plywood, in laminates, in MDF, and so on and so forth. So I think what has helped us is that we're the lowest cost manufacturer, and we're the highest price seller, particularly as far as plywood is concerned, and similar in other industries as well. So that operating efficiency does bring certain advantages with it. In terms of gaining market share, I think it is not just to do with pricing. There are a lot of things that go into it. For instance, the quality of a product, for instance, your campaign, your marketing campaigns, for instance, the team, the distribution, supply chain that you've been able to build up. So I think that going forward, we should see an increase in margins alongside increasing market share. Currently, I would say that we have gained some market share from the unorganized as well as some market share from the organized.
I'll talk to you about blended margins in just a bit, but talk to us about this 18% kind of CAGR growth that you're likely going to pencil in over the next 5 years. How confident are you of this kind of growth? Because it's a very, very large aspiration to get to 12,000 crore in terms of top line.
You know, the proof of the pudding is in the eating. So currently, we have been able to deliver the same. And like you rightly pointed out, the market isn't as robust as it has been, say, a couple of years earlier. So we are fairly confident. In order to achieve these high ambitious targets, you need to invest. And as you have seen, we have invested substantially. I think despite having very, very strong cash flows, we have had to take on some debt because till 2020, our total capex wasn't even 1,000 crores in our first 34 years of existence. In the past 5 years, we have taken on more than 2,000 crores worth of capex. So that sort of an increase does require some amount of leverage. But with strong internal accruals, with strong cash flows, I think that we will be able to invest in the business and we'll be able to create capacities so as to head towards our 12,000 crore target.
Right. Keshav, what went wrong in FY25 where cash flows is concerned? Because you were negative on your operating cash flows. I'm trying to get a sense as to where was the pain point for you?
I think nothing, to be honest, went wrong. What happened was that there was a sharp escalation in raw material price, like you rightly pointed out earlier. And in line with the same, we built up a huge amount of inventory. So while that led to operating cash flow negative on the books, H1, we have been able to liquidate a lot of that in a stable price environment and generate substantial amount of free cash flow. So this was a precaution that was taken on the business side in the face of extremely high volatility in raw material prices. And you're going to see the positive results, or you are seeing the positive results of the same within the first half, and you'll continue to see the same going forward.
Understandable. And with regard to your margins, your blended margins, you're saying the next 12 months will be a bit of a turnaround in terms of both raw material prices as well as how your margins inch up because pricing will go up. So how do you expect your blended margins to shape up? And are you confident of an 18% linear growth even next year?
So to be honest, we haven't given growth guidance numbers for the next year. So I won't be able to share those with you right now. But I think our growth trajectory will largely be on track. As far as margin guidance is concerned, 12 to 14 for plywood for the current year, 10% plus for laminates, 15% for MDF, and 15% for particle boards. I'm fairly certain we'll be able to deliver on those.
Okay. And with regard to how your next year in terms of volumes is expected to shape up, how much of the growth is likely to be volume-led? How much of it is likely to be pricing-led? Could you give us some color on that?
See, with a substantial amount of headwinds, the growth that we have done this year, I think, has been fairly significant. And hopefully, based on all the predictions and projections that various people, various experts, including yourself, have been saying, there should be a turnaround in the building material industry, perhaps from as early as H1 of next year. So I'm fairly sure that in terms of growth, we should be doing something similar, if not better, than what we have done in the current year.
Okay. All right. Non-committal, if I can call it that, Keshav. Okay. Let's talk about capex, because that's going to be critical to get you to the 12,000 crore top line. 2,000 to 2,500 crore is the capex that you're looking for by FY 28-29. Give us the glide path and give us the timing of when do you do that capex.
So again, from your point of view, I'm going to be non-committal because we don't have board approval for a number of projects that are currently in the works, which we are exploring. But as capacity utilization keeps increasing, we will need to create additional capacities. I think earlier in your analysis, you had rightly pointed out we are not a trading organization. We are a hardcore manufacturing organization where the quality of our products is the differentiator between us and anybody else in the industry. So we will have to create capacity as and when we reach utilization levels. In MDF, in plywood, we've been growing at a fast pace, and alongside the same, you'll see a high utilization. And once we reach 80% plus utilization of the expanded capacities, I think we'll have to plan for what's next. So as and when our numbers are moving higher, as and when our utilization numbers move towards that 80-90%, we'll have to plan for capacity addition. Certain things are already in the pipeline, but I'll let you know as and when they're finalized and when my board approves the same.
Sure. And with regard to where do you plan to fund this cash flow from? Because as you said, debt has gone up. At what level at what level are you comfortable on taking the debt to? And how much of this capex will likely come from debt, equity, and the like?
I think that our cash flows have been very strong. If you look at a holistic picture over the course of the past 3 to 4 years, I think going forward, internal accruals are going to be the predominant source of our capex. And if you look at the debt figure, our target is always to maintain debt within long-term debt within 1x of EBITDA. I think we're going to be able to keep it stable at that sort of a level or below that going forward. So I'm seeing internal accruals as the primary source of our growth.
Okay, so long-term debt is going to be one-time EBITDA and not more. That's the target, of course, internally for the moment.
Yes.
Okay, and with regard to at what rate would you be taking on this debt? How heavy is it on your P&L in terms of interest cost?
I think in terms of interest cost, we would be at a level where we are at 8%. So with 1x of debt to EBITDA, I think we are in a comfortable position.
Yeah, that makes a lot of sense. You're well covered in that sense. With regard to you doing what you did last year, which is you took on additional inventory in terms of stocking up with regard to timber, etc. Do you plan to do that on an annual basis? Is that something that will recur, or was that just a one-off because you saw it in terms of market conditions?
I think this is the second time that we have increased inventory disproportionately over the course of the last 16 years that I have been in business. So I don't think it is a recurring phenomenon. These steep raw material price increases happen when there's a dynamic shift in the industry. And considering the potential that our industry has going forward, I think that shift has happened. Perhaps in the next 5 to 6 years, I don't see any sort of a need for that drastic a correction.
And Keshav, with regard to laminates, you've brought in a CEO and someone who is well placed to kind of drive that business forward. How much of that business will likely come from exports? How large is the opportunity there? How will you be able to compete there versus how are other competitors? How are price points shaping up? Give us some color on that.
So I think our focus has been predominantly domestic heavy. But over the course of the past 2 to 3 years, we realized that we need to leave behind the tyranny of or and focus on the power of and. So why not domestic and export? And in exports, we have created capacity. So earlier, our largest press size was 8 by 4. But for international markets, you need 14 by 6 presses, you need 10 by 4 quarter presses, and you need higher sizes. So our Badvel facility only has higher size presses. And I think with this investment, we have been able to create a place for ourselves in the export market for larger sizes at a faster pace than most others have. The traction that we are seeing from our products, predominantly due to quality and due to our track record and reputation in the market, has been superb. And I see exports contributing a larger percentage of our turnover as far as laminates is concerned year after year. This is due to the low base.
Keshav, with regard to your ROC, it's come off sharply, right? It's come back to 10%. You've invested heavily in the business. There was sharp working capital increase as well. All of that will unwind starting FY26 itself. How quickly do you think it can go above 15%? Will you go above 15% straight away in FY26 itself? And will it rise to the 20, 25, 30% levels which you've historically clocked?
So, there's a saying that turnover is vanity, profit is sanity, and cash is reality. So at the end of it, any business has to generate good ROC to be sustainable in the long term. Our target has always been 20%. And you very rightly pointed out that due to the sharp capex and the fact that these large capacities take some time to stabilize and to reach operating leverage, we are seeing a difficult couple of years. Having said that, this was anticipated, this was planned for, and all our projections were given in line. Going forward, within 2 years, I think we should be back to 20% ROC levels. Currently, our target is 20%, and that 30, 35, if and when it happens, it will be a very welcome boost, but the target is 20% ROC.
Perfect. Keshav, this has been a very good conversation. Thank you so much for coming in. Apologies if we put you in a tough spot, if at all that is so, but really, really appreciate you coming in and speaking with us. Thanks so much.
And Thank you so much.
In fact, that's all the time we have as well on this edition of the show. Thanks so much for tuning in.